Good afternoon, everyone. Good morning, everyone. Good evening, everyone. This is session 9 of MOOC 12, Cryptocurrencies and Financial Institutions. We have a set of questions again, as always. We'll go through these questions. Once we've covered these questions, we'll see if there's anything in the chat that is relevant or interesting. And if not, we'll cover any other topics remaining. So we're going to just jump into the first question. Are we ready for a kind of money which is completely digital? It says cryptocurrencies. And the question then goes into more detail. In slide 8 of the presentation, it says a large number of people are still unbanked, according to World Bank data. This report shows us that 31% of people don't have bank accounts worldwide. This percentage includes the hard work of people who live without financial systems or outside of the financial system. And how can a blockchain, a sophisticated technology, help people with poor education? So, yeah, this is a good question. It effectively is saying, if you have people who are living in relatively undeveloped economies, they themselves might be in a relatively undeveloped sector of their own economy. Maybe they're not the most highly computer literate or educated people in the world, and that's not necessarily true, but it could be true. Is really the answer something as complex, difficult as blockchain technologies, which is always one of those, good topics that even very sophisticated people get wrong or don't understand fully, and so on. So, yeah, I think that's a fair question. It's actually one of my big questions in general when I read about how blockchain is going to save the developing world or solve clean water or so on and so forth. It's tricky. You have to think through, you have to take it down from these general statements to something more specific. And so let's talk about what that might mean. The first thing I would say, it is perfectly possible to be technologically literate and unbanked. Surprisingly enough, in the United States, there is a solid 10 to 20% of the population that remains unbanked in the United States, which you wouldn't think that would happen, and yet it does, and there's a variety of reasons why people do it, and yet they do, and these are people certainly who have computers, have cell phones, know how to use technology, and for a variety of reasons choose not to have a formal checking or savings account and handle their financial affairs on a more ad hoc basis, on a more episodic basis, on a more service-oriented basis. So my first answer to the question is not everyone who is unbanked is technologically unsophisticated. And then someone might say, sure, that's fine. Let's take those out of the equation. Let's look at the rest. And I say, sure. When we start looking at the rest, and it's a topic we'll see later in this MOOC, is the concept of leapfrogging, which is there will be whole regions where technology will get to them before banking will get to them. Because if you think about how banks used to expand for hundreds of years, they'd have to have a bank branch and build a building, and you make it nice so people entrust you with their money, and it costs a lot of money, and how technology might get to a certain region or town or village is you have a cell phone and there's a cell tower, and then you're done. There is in some way the whole access to all the world's applications, information, and knowledge is now in your town. So you might, second bucket of people, be people who might not be technologically literate now, may not be banked now, but they will become technologically literate before they become banked. In fact, from where we stand today, I think that's likely to be the default case. If you are today technologically not highly literate and also unbanked, I suspect you will become a user of a smartphone much earlier than you will become a customer of a formal bank. That's the second part. Third part. Let's say you are not hugely technologically literate, you are not banked, and you become banked. In what format are you going to become banked? Well, the question, or the header on the question, says the word digital, but digital doesn't mean cryptocurrency, right? WePay and Alipay are digital systems, and they're not in any way cryptocurrencies. And they are digital systems that do not require any particular sophistication to use. In fact, you could argue that these are systems that are easier to use than the traditional banking system. So if you think about what banking was, I'm old enough to remember concepts of, oh, you have to keep your checkbook balanced. You have a check, you sign it, there's carbon paper below, you leave a copy, or you write on the little side what check number it was, what amount it was, and then you keep the balance, and so you know how much money is going to be left in your bank account once your check's clear. This took, I'm not saying this is advanced calculus, but it took some organization, some math skills, and was one of those home economics life skills you used to learn in the 1980s. If you want to send a payment on Alipay to buy a coffee from a merchant in China, well, it's easier than using a checkbook. Well, there's less rigmarole than the traditional banking system had. And so so now we're in the third bucket, right? The third bucket is there will be digital systems. They will not be blockchain based, and they will be easy to use. So now we've covered three buckets, right? The bucket one is you're not banked, but you're technologically literate. Bucket two is you're not banked, you're not technologically literate. You will become technologically literate before you become banked. Bucket three is you're not banked, you're not technologically literate, but an easy to use technological solution will come to you that is digital and has nothing to do with the blockchain. I've covered three areas. The fourth now is you're not banked, you're not technologically literate, you're going to get banked with a blockchain-based solution, then it will not be adopted. It will not help the unbanked of the world. It will not help them become banked. It will not help them solve any other coordination problems. It will not be any solution whatsoever. For any mass adoption of any technology, it has to be made straightforward and simple to the end user. Things that people think are easy are often embedding or burying a huge amount of technological complexity. Right? If you go on Instagram and like a picture, so think about someone who may or may not be super technologically literate, but has a cell phone and has Instagram and sees a picture and presses the heart and the heart lights up. But you don't need a computer science degree for that, right? The amount of technology to run your phone, run a computer on your phone, have an application platform on your phone, send requests through the 4G infrastructure that has a wide variety of network equipment that itself has extremely sophisticated routing code to get to a server farm in some data center that is running very high scalable, very sophisticated code and generations and generations of a technology stack, each one of them difficult and complex, so that that whole interaction decides which is the next picture it's going to show you on Instagram. It is massively technically complicated. It has been built over decades. Most of the technologists who are working in the space, not most of them, effectively all of the technologists who are working to build that stack, make that application, do not have an understanding of the full stack. So the person who's responsible for making the high performance system to return the photo, just to stream the photo through a content delivering network to your phone at Instagram, certainly does not have a detailed understanding of the routing protocol in the Nokia base station that is linking to your phone and so on. And it has been built up over the contributions of millions of people over decades to have an infrastructure that makes Instagram work. For blockchain to have, or cryptocurrencies to have, a very large impact, we have to get to that state of end user simplicity, right? Blockchains, cryptocurrencies are a tool. They are not the application. Someone might argue, well, storing some money in Bitcoin in of itself is an application. Sure, but that's not what people are talking about here, right? Like, people are talking about how can you use it to do some banking and so on and so forth. Well, we're, I think, a long way away from that, and you kind of know this because you go to conferences, including our conferences, and it's still mostly about how sophisticated and cool the technology is, which is fine, and it is sophisticated, it's cool, and it makes for good conferences with other technologists. But nobody cares, right? Like, I mean, if you want something that's going to impact billions of people, none of those billions of people at a first approximation care that your technology has very elegantly solved the Byzantine general's problem of distributed computing. Nobody cares. People use applications at scale to get things done that they need to get done in their daily life at scale. Whether on the other side of that is an Oracle database, whether it's Ripple, whether it's Bitcoin, whether it's Hyperledger, nobody cares. And so this is the challenge. The challenge is thinking about what are the applications that actually will help people. What is something that they don't have today that if they had it, it would allow them to do something that they couldn't previously do and that's important to them? And how does a cryptocurrency or a blockchain allow you to do that in a way that you wouldn't have been able to do that without it? Which is a very sophisticated question, actually. It's a question of architecture and incentives and economics. You know, cryptocurrencies are helpful for censorship resistance. Cryptocurrencies and blockchains in general are helpful for coordinating large numbers of parties that might not be able to agree on a central coordination point otherwise. Is that relevant for your application? Is that relevant for someone for whom you're going to solve some unbanked problem? I don't know. It depends on the application. It depends on the financial infrastructure in that country. It depends on who are the different parties that you're trying to coordinate to get this thing done. And so this isn't the most satisfying answer, perhaps, because it's a difficult answer. But I believe it's been one of the embedded philosophies of this program from the beginning, that taking this from a small group of people to a large group of people involves solving problems like this. And on the whole, I think it's playing out the way I thought it would. Like, you have not had massive retail adoption for non-investing purposes of cryptocurrencies because I don't think the value proposition is there. I don't think the simplicity of use is there. I don't think people have quite conceptualized how to put the pieces together. So, well, what does that mean? Is that negative? No, I mean, I don't think it's negative. I think it's how it is. It's practically speaking how it's going to develop. I think it's going to do some base layer work first. Public cryptocurrency to settle and execute contracts remotely in a coordinated manner that cannot be censored, and that's interesting. And enterprise blockchains allow you to coordinate hundreds or thousands of parties in an industry who might otherwise feel competitive in letting someone be in charge, right? These are for sure the two fundamental business usage breakthroughs. And then those things are not, I think, hugely relevant to an end consumer. The answer for an end consumer might be found a layer above or a layer above. So you have this blockchain-based, cryptocurrency-based system that does the integration across parties. And then someone builds an application a layer above that exists because the parties are working together, or someone even builds a layer above that. And that's not different than how the internet works. If you look at WeChat is not a base layer implementation of the internet, right? Like first you have to have TCP/IP, and then people got the web, and then you had mobile apps, and then you had whole software frameworks, and then you have to have mobile internet infrastructure. So depending on how you start counting the layers, WeChat is 3, 4, 5, 6 layers away from the base technology. And because it is, and you're not dealing with the underlying technology, you have actually a clean, easy to use system. So I think we're still at the early stages, we're at the infrastructural stages. I do not think there are magic bullets that are called, if you do this, then the developing world will become backed with cryptocurrency. It is the way to analyze it is to think through specifically what it is that person is going to do, what it is they're going to use, and how does it allow them to end-to-end accomplish something that they couldn't have otherwise. So, with that, let me go to the next question. A very popular question. We get this every time. It seems like through 2018 and 2019, after the latest 2017 scare, ICOs have become less popular. This year we have seen the rise of the initial exchange offering, IEO, often launched on Binance instead of Ethereum with the ICO model. What do you think about this IEO model? Is Binance a new serious actor in crypto finance? Do you think that in the long run ICOs will survive or even thrive again? Or will some new models appear? Right, so part of the reason ICOs to me had two very big conclusions that came out of ICOs. First, let's start with the good news. There is, and not everyone agrees with me on this, but I think I'm right. They have uncovered that there is huge, latent, global retail demand for startup business ventures. Now, the people who disagree with me are like, no one actually understood that. They just thought it was a get quick rich scam, but I'm not sure that's quite right. I'm not sure the point of view between a retail investor investing in some type of ICO and a venture capitalist investing in some type of seed stage or early stage firm is hugely different in motivations, right? Maybe it's different in skill levels, but I'm not sure it's different in motivations. What we saw with ICOs that I thought was super important is the theory that the only way to access capital is through the general partners of some limited partnerships in Silicon Valley or in Tel Aviv or in China that they will wisely decide what the right startups are. We saw that breakdown. That's the good news. The bad news is it broke down in a way that basically played into everyone's worst case scenario about why you don't let retail investors invest in unregistered startup securities. In other words, a huge percentage of the IPOs were, let's call it, a poor value to the investor. People throw the word scam around a lot. I think it's not totally exactly the right word. I think the word is some ICOs were in fact actual scams. And by actual scams, it's a promoter who was just abusing the moment in time, does not necessarily think their idea is a good idea, has no intention of actually executing the idea in any case, sees this as a way to raise a few millions or tens of millions or hundreds of millions of dollars and then go off and effectively take the money and run. Those are, of course, scams in the proper sense of the word. I think there's another set of ICOs that were people who thought they had a good idea but did not actually have a good idea. And that's no different than the startup world. In the startup world, for every firm that makes it through the seed stage and Series A stage and Series B stage and Series D to a successful long-term profitable outcome or a sale to a big company or an IPO, almost all firms fall in that pathway. So 90x% don't make it. I think there are a lot of firms in the second bucket as well. A lot of ICOs were in the second bucket. The difference is there has been mostly, and I put a question mark, but mostly, a more disciplined approach in traditional private markets and how those firms raise financing, what type of rigor is asked of them to prove certain points before getting other rounds of financing. And so it's probably fair to say that there wasn't quite as much scrutiny of these things as there would have been if they were startups. So firms that, if they went to Silicon Valley and the team was X and the idea was Y and neither one of them were very good, might have never raised a Series A, would do an ICO and would raise $30 million, and wow, I mean, it was disconcerting to me. I've met a lot of these people in 2017, and I would meet them and say, tell me your concept, and their concept was, nonsense. And you're like, well, so what are you doing? Are you raising money? He's like, oh, no, we raised $33 million. You say, okay, that's super interesting. I don't have high hopes of what's going to happen to the $33 million. And this company probably wouldn't have raised money at all in Silicon Valley. So, now, again, are these black and white? No, not black and white. One of the most sophisticated people in the world, with some of the most sophisticated limited partners in the world. So the Vision Fund, backed by a lot of Saudi money, apparently got the valuation of WeWork wrong by 90%, 80%. They did their last round at $47 billion, and now we've all decided it's worth $7 billion, like 3 months later. So nothing changes the fact that startups are hard. Valuation of startups is hard. Figuring out how a startup should be funded, when it should be funded, what's the right amount of it funded, and what it needs to get to the next stage is very, very hard, and very few people have been consistently good at it, largely because I think there's a component of luck to it, whatever people say. Now, the issue is more complicated than that, though. I believe the ICO boom in 2017 had what's known in economic terms a lemon problem. What do I mean by a lemon problem? I mean the following. If you don't know, it's, analogy was first used in economics and the used cars. And it took as a presupposition, you couldn't tell if a used car was in good shape or in bad shape. Well, if you have a used car and it's not good, and no one can tell it's not good, you might be inclined to sell it. And if you have a used car and it is good, you might be inclined not to sell it. And given this, more poor condition used cars come to market. So the market adjusts and the price lowers towards that of a bad car, a lemon. And again, if you have, it makes it even less likely if you have a good car you're going to sell into that price. And eventually, everything just ends up being lemons. I believe the 2017 era ICOs had this type of problem, right? Because it was clear to more sophisticated investors, more sophisticated startup founders, that some of these ICOs, the regulators might come back and say, you know, this was an unregistered securities offering. It's illegal. You shouldn't have done this. So who tends not to do activities that have a high likelihood of your regulator or the police or what have you come and say, you know, you're breaking the law? Well, kind of sensible, logical, law-abiding entrepreneurs. Who are the people who differentially aren't too bothered by this? Who say, it's okay, you only live once, we're all in? Well, people who want to run a scam and just are constitutionally unalarmed by such things, or people who are too naive to know better. Neither of those two things are the right model for ensuring a great mix of ICOs. So almost by definition, what I'm saying is the reason a large majority of ICOs were bad is given the regulatory framework or lack of regulatory framework and the likely outcome that the regulatory framework would tighten up, you'd have to be someone that almost by definition wasn't responsible in order to be the promoter of an ICO. And so in that world, you get a lot of irresponsible ICOs. So is this the permanent state of affairs? Like, we're now done, we're not going to do ICOs again? I would like to think not, because I think there was something important in tapping this broader retail interest to do things. It certainly was not good for the retail investor what actually happened. I mean, there was a lot of scammy behavior. But I do believe there will be some ability with the proper regulatory framework in place, whatever that turns out to be, and maybe a more sensible next generation of ICO promoters, and possibly some services, substantive services, to help guide people, that you could do something along the lines of, you say ICOs and it seems maybe bad. If I say crowdfunding of new ideas, that seems good. If I ask myself, is it possible that under certain conditions, and I can't promise you I know exactly what those conditions are, but under certain condition, the wisdom of global crowds will fund startups that deserve to be funded and should be funded and are concepts that should be funded, and we're not going to be funded by VCs? Yeah, that sounds right. That sounds like where we should end up. But it wasn't on the whole the 2017 era of ICOs. So, to close up on ICOs before we go to IEOs, I think the main points were tremendous untapped retail demand, a lot of scammy behavior. The structure of the market encouraged scammy behavior. The regulators have moved in. The regulation will come into place. It might overreact in some areas. And I'm hopeful, though I can't say when and how and in what mechanism, that there will be a new generation of ICOs that are more sensible and more responsible and better thought out. When you don't have this super boom environment, hey, you do an ICO and you're going to be instantly rich, there's less incentive to write a completely half-baked white paper and say, oh, look, I'm doing ICOs for cat heart surgery or something. I haven't seen that, but close to that. And just get it out there, and then it's not very sensible, and then it doesn't work. So that's where I am on ICOs. On IEOs, I don't think they're meaningfully different than ICOs. I mean, the bubble has died down in general. I'm not sure what the substantive difference is. That you can still be a retail investor. You have to be a client of the exchange. My first reaction is, so what? Why does that matter? It's not like being a client of an exchange is some type of tremendous life accomplishment. And then if you're a client of the exchange, you can do something that you couldn't if you were an individual retail investor. Now, the other thing I think people would say is that the exchanges are screening them and making sure they're up to a certain quality level. I'm not convinced that's... I don't want to say that they're not screening them. They might be screening them. I'm not sure that matters. And why am I saying that? I mean, maybe it might take out the absolutely worst ideas. But if we go back to the beginning of this question, one kind of obvious conclusion about venture capital is that venture capital is very hard, right? 3/4 of venture capital firms do not perform above any kind of sensible benchmark. It's only the top quartile that performs, and even without the fourth quartile, it's in the very top of that quartile. And so the average, the median venture capitalist is not actually very good at their job, and it's not because they're weak, right? It's because it's hard. It's hard to look at startups and figure out which ones are going to be the 1 or 5 or 10% that will make it through all the gauntlets that can go wrong, all the problems that can go wrong. Well, it seems implausible to me that buried inside an exchange, there is a top-tier venture capital firm just waiting to blossom, right? Like, why would that be the case? Why would it be the case that when people who are professional venture capitalists, declared venture capitalists, aren't very good at solving this very tricky problem of picking startups, but the IEO vetting division of Exchange X is somehow going to be much better at it? I don't think so, right? So I think it hasn't solved the fundamental problem. It might clear out the absolutely worst actors, but it's not going to clear out the second problem of people who are well-intentioned but just don't know what they're doing. I don't think that's going to happen. And you end up into other issues depending on how they're doing it and how they're KYCing you and how the exchange is structured and where the exchange is structured. If the exchange is now an unregistered broker-dealer, an unregistered securities offering, an unregistered broker-dealer, and if you've just taken all the regulatory problems and made them worse, which is a possibility that that's what you've done. So, there's not to say that I don't think IEOs will continue. I think there will be some mix of IEOs and ICOs, but not. There's a lot of maturing that needs to happen in the space, is the absolute minimum one can say about this. Now, is Binance a serious actor in crypto finance? No, Binance is a very serious firm. I mean, it's been a very successful firm. It has a lot of revenue, and certain years it had a lot of profit, and it has certainly been very ambitious in how it has gone about its business. Can I tell you if I believe there will be a big winner in 3 and 5 and 10 years? No, I don't. I suspect they don't even know. I'm sure they think they will be. It's almost a definitional characteristic for a very ambitious entrepreneur. But it's a difficult business. It's a very competitive business. It's a business that has a lot of regulatory pressure on it. And I don't know how it's going to play out, but for sure they're one of the big actors in the space now. Do you think that one key factor will be industry self-regulation of cryptocurrencies? No, I'm a little skeptical of this, actually. I don't know how it would work. First of all, I don't know who the industry would be, right? Like, when we decide the self-regulation rules, do I get a vote? Am I in the industry? If you've transacted with a cryptocurrency, are you in the industry? If you hold a cryptocurrency, are you in the industry? Do we mean the exchanges in the industry? The software developers in the industry, the service tool providers? So I think kind of my first problem with this, or difficulty that I would see, is how do you define the industry? If you said, can self-regulation work for insurance brokers? You've at least solved the first problem. It is very identifiable who an insurance broker is. Like if someone goes to work and their job is trying to get you to sign up for life insurance, they are very likely to be an insurance broker. And if someone goes to work and their job is teaching artificial intelligence at the University of Nicosia, they're very likely not to be an insurance broker, and it's a pretty bright line. If you ask me who's in the cryptocurrency industry, I don't know. I mean, there's kind of this integrated relationship between the providers and the users and the developers and the applications running on top of it. I think it's a fuzzy line. So that's problem one. I don't know how we're going to define the industry. And then problem two, as far as I can tell, there are wildly different views on what you would regulate or not regulate. Right? I mean, think about, or first, if you should be regulating at all, but like what is a good idea or not a good idea? For those who are active in the space, then the fork wars, where some people thought Bitcoin needed to increase its transaction throughput to survive and be competitive and meet the vision that it was originally founded for, and the people who thought, no, this was a security risk and a centralization risk and it should stay as it is for now, was, for all intents and purposes, a religious war. I mean, it was very, very strongly contested on both sides and took on tones of the other side is trying to destroy Bitcoin. Both sides were, broadly speaking, in the industry. What does this... And here, on something that they agreed on, which is Bitcoin, right? Like, they were all Bitcoin users. And I believe all of them preferred Bitcoin to, most of them, to like Ethereum or Ripple or Filecoin. If they didn't, they wouldn't be so passionate about this discussion. And so there are people who, on the world spectrum of interests, were right next to each other. Right? So it's like 95% of the world doesn't even think about cryptocurrencies, and the people think about cryptocurrencies. People think about a lot of different cryptocurrencies, and the people that think about Bitcoin, most of them don't get all that worked up. And so the people that get worked up about Bitcoin block size, it's like, I don't know, a 1/10 of a percent or a 1/10 of a percent of the world population, in how similar they are in their worldviews. Right? They think Bitcoin's going to be super successful and it's super important, and like they don't need to fight hard so that the vision is correct. And even within this bucket of people, they were saying, one of them was saying it's day, and the other was saying, no, it's night. And they were looking at the exact same set of facts. And for one of them, it was noon in the Arizona desert. And for the other one, it was midnight in the Arctic on the coldest day of the year. And that got resolved not because they agreed on anything, but because they actually split. They forked. And the people who believed X went in one direction, and the people who believed Y went in another direction, and they each tested their hypothesis to see who was right, or if right's not the right construct, they each have the opportunity to run a chain that implements and embeds their assumptions about what the best Bitcoin-like chain should look like. So if this all happened on some very relatively tightly defined question, the thought that the industry is going to self-regulate all tokens and security tokens and payment tokens and utility tokens and all that, I don't think that's going to happen. So I think you're going to end up with some type of regulation in the classic sense. It's going to be half wrong at first, I think, and will not even with well-meaning regulators, it might be half wrong because it's hard to get it right. And then we'll see. Someone will get it closer to right, and then I think people will flock there. And as people sort out what's the right way to do this, or what's the right balance between risks and rewards, between regulatory pressure and freedom to experiment, over time, the system will evolve in that direction. But I think it's going to be slow. I think it's going to be painful. I think it's going to be annoying. I think people will say, like, well, why are the regulators doing these things? And the regulators are going to say, well, because the last time we didn't regulate you, you guys went and stole everyone's money. I mean, I think it's that type of feel as opposed to the regulators saying, well, you guys did such a fabulous job self-regulating last time. We'll just leave it in your hands and go worry about other things. I don't see that happening. Next question. The transaction number per second processed with most blockchains is too low. Isn't that another reason why financial institutions and merchants are reluctant to adopt cryptocurrencies? This one I have an easy answer. No, I don't think that's the problem. I don't think there are very many financial institutions and merchants whose problem is specifically this. We are super excited about using cryptocurrencies to do X. The reason we're not doing it is our volume is going to just overwhelm the system and crash Bitcoin, Ethereum, etc., etc., etc. Generally, they're stuck on some predecessor problem to that of, why do we want to use this in the first place? Not we're using it and it's too successful and we need to run too many transactions on it. And so I think that's a little bit of a red herring. You get this a lot, like someone launches a new blockchain and they say, right? I don't know how many announcements they say, a lot. We can do many transactions per second. Okay, great, and then super. But that hasn't so far been, I think, the actual sticking point. And by the way, there are many non-blockchain based solutions that can do an awful lot of transactions per second. The way to do the most transactions per second is to have a very fast server running a database, and then you will do an awful lot of transactions per second. This is not to say that transactions per second are not important for certain usage cases. They certainly will be. But what I believe is we're stuck at more primitive problems, that we haven't gotten to that problem in most cases. So am I worried about it? Are we going to end up with centralized systems because we can't do too many transactions per second? No, I'm actually not worried about that at all, and I'll give you kind of a specific answer, but I'll also give you a general answer, and the general answer is the one I actually believe. The specific answer is going to say, well, look, there's blockchains that can do high transactions per second, and there are blockchains that, and there's a lot of work being done on layer 1 and layer 2 solutions on top of the fewer transaction per second blockchains that will allow you to do a lot of transactions but a layer above, and people are going to have a whole bunch of, very opinionated battles about which one's better or not better, and that's fine, but I'm going to park that issue because I don't think that's not why I'm not worried about it. I am not worried about it because one of my broader heuristics in life, which was hammered home I grew up in the internet. I grew up professionally in the internet expansion era. And I can't tell you how many times the internet was going to collapse because too much usage. It's going to collapse because of too many emails. It's going to collapse because of streaming video. It's going to collapse because of streaming video on mobile, and so on and so forth. And turns out systems do not fail because too many people want to use them. Because if too many people want to use them, usually it means there is economic value associated with their usage case. And if there's economic value, it is suddenly very much in your economic interest to hire a lot of engineers and figure out how to make X, Y, Z actually scale, which is what has happened time and time and time and time again with the internet. So what are we going to do when lots of people want to use our system? Tends to be a luxury problem that's a good problem to have and that ends up getting solved. Always for me, the harder problem is, what are we going to do when nobody wants to use our system? The opposite of a scalability problem is not a luxury problem, it's a real problem. And it's a real problem because you haven't uncovered any underlying demand. And if you haven't uncovered any underlying demand, it doesn't matter if your blockchain can do 80,000 transactions per minute, because nobody wants to do 80,000 transactions per minute or 800 transactions or 8 transactions per minute on your blockchain. So to me, I always worry about the demand side. If the demand side is there, you will find solutions to the supply side. Okay, next question. Don't you guys find it dangerous that the Central Bank of China is adopting tokenized money to better control and again have more information on their citizens, or the ECB having intention to adopt cryptocurrency in order to impose a cashless society in which they're going to charge us a negative interest rate much more easily? Okay, well, I think it is generally true that the Chinese technological and economic system has a very high degree of control embedded in it, and my assessment is that was going to happen anyway in all cases, whether or not cryptocurrency is involved. So I'm not sure that a blockchain-based permissioned system is going to be more controlled than a Alipay system, which is also, of course, permissioned. So I'm not losing overall too much sleep about this. It's clear that at this point in time, China tends to run permission systems, even in the traditional financial sector, right? It doesn't have a convertible currency, for example. So it would be very strange and unusual and surprising to me if, without a convertible currency and in a fairly controlled permission system, China suddenly said, all right, super news, we're going to run a central bank digital currency on a permissionless system, and you only live once, let's see what happens. It seems like almost impossible to imagine that scenario. So, and in fact, that's not what's going to happen. So I think this is, if you're worried about whether China has too much permissioning in their systems, I think your issue is more broadly than China is more too centralized for your liking, and that's fine. It's just not a crypto issue. It's a kind of political system issue. Second part of the question is, is the ECB going to have us adopt crypto so that they can apply negative interest rates? I think there are voices in the ECB that would like to push out cash, have a more digital currency, of which one of the benefits would be kind of AML sanctioning, and the other benefit would be the ability to apply negative interest rates. I think that's right. They don't need crypto to do this, by the way. All they need to do is phase out cash, and a digital non-crypto system would be perfectly fine to do this. So again, the ECB may in fact want to do this, though I doubt the ECB officially has that position. I think there are some commentators that talk about this, but they have not come out and said this officially. But again, it's not a crypto issue. It's something the ECB might or might not be interested in any case. Last one of the existing questions. I don't see how financial institutions, and especially central banks, will adopt open source and decentralized technology when they're dealing with so much sensitive and private information. This is perhaps why they've chosen centralized blockchain projects like Ripple. Don't you think they might also choose to go with a project like Corda and Hyperledger in order to have permissioned and private blockchains? As a future blockchain developer, don't you think that it might be a good idea to learn how to code these two projects? Yes. I think central banks are going to do a lot of trials for tokenized money. I believe on the whole those trials will not be on permissionless systems. They will be on permission systems. I believe on the whole they will not be on custom, bespoke, developed from scratch systems. They will work on some existing platform. I believe the platforms they will work on will be platforms like Hyperledger and Corda and Ripple and so on. I believe there will be a lot of job placements in these areas because not a lot of people know how to program them. And leaving aside any political or geopolitical significance in my answer, do I believe that if you have development skills in these platforms, there will be a good number of job postings that you will be eligible for? Yeah, I think that's right. And this is a kind of career question, not a infrastructure or architecture of financial systems question. I do believe there will be job positions for people with those skills. So these were the pre-existing questions. I saw a couple of ones in the chat. Let me answer the ones that are kind of like sensible ones. What do you say about STOs? Due to strict laws, STOs, or the idea of stablecoin projects, is not progressing. I think there needs to be a balance in the legal framework. Yeah, look, the best stablecoins are going to be central bank backed. I mean, the party with the least counterparty risk for a national currency is the central bank of, for national currency, stablecoin is the central bank of that country. In the meantime, you will have private stablecoins. I'm a little bit more skeptical about them over the long term for this reason. I think a lot of banks will ultimately tokenize their currency, and by definition, that's going to be the ultimate stablecoin for that currency. The STO question, securities tokens, which implies a regulatory framework that recognizes them as security tokens, I think relates to the discussion we're having earlier about ICOs, where there will now be regulation or an awareness that regulation is coming. Is this going to be at the right level? Will it swing too far? Will it not go enough? I think it remains to be seen. I think we will see all outcomes. And eventually the market will stabilize in some equilibrium or another, I think. Related question that's back to the kind of banking question. Why would one use Bitcoin day to day if holding is an always win game because it's deflationary, and then if we're not going to use Bitcoin day to day, aren't we just going to get stuck with a current financial model? I think it's a red herring, to be honest, again. First of all, there's no place that I've seen written that I would say feel comfortable that if you hold Bitcoin, the price is always going to go up. That's just, you can believe that, and many people believe that. And that might be right. But it's not like a law of nature like gravity, right? Or I guess in this case, anti-gravity. It's always going to go up, not down. So that's issue one. Issue two, you could always separate out your investment holdings from your day-to-day holdings. Everyone does this in practice in the real world anyway, right? Like imagine there was no Bitcoin. Nobody keeps 100% of their money in stocks, bonds, commodities. I didn't say nobody, probably someone does, but no one really does it. They say, these are my investment funds, and I'm going to invest these funds. And then I have, a checking account. And in my checking account are the funds that I use for payments. It's my means of exchange. It's my unit of account, and it's separate from the stuff that I've done to generate long-term investment value. I don't see why you couldn't do that with a cryptocurrency as well. Say like I want to stash 10 Bitcoins because I think they're going to be super valuable in the future, and that's my investment. And then day to day for my monthly needs, I'm going to have a liquid Bitcoin. I have $4,000 in my checking account, and I pay my rent, and then I get paid, and I pay my rent, and then I get paid. You can't operate without some short-term liquidity. This is true with sovereign currencies. This is true with cryptocurrencies. Everyone's life is structured so you have some short-term liquidity. You can't say my desired outcome is I'm 100% invested at all time in my long-term investments. Practically speaking, you need to pay for a coffee, and you don't want to have to liquidate your long-term investments to pay for a coffee. So I think the reason people aren't using Bitcoin for day-to-day transactions is less about that. It's more about, there's kind of some tax issues that are problematic. But it's more, I think it's deeper than that. There's not a particularly good reason to do so. And so I'm pretty sophisticated as far as knowledge about Bitcoin goes, and I do not have a day-to-day compelling reason to buy my iced coffee here in Cyprus with Bitcoin as opposed to good old-fashioned cash or a debit card or a credit card. So I think if there was an actual good usage case, the deflationary issue is manageable. So, all right, we're about 5 minutes over. It's a question about MakerDAO. I don't know. I don't have a strong opinion that I would say, one way or another. And then it's kind of, and DAI, and then DeFi, decentralized finance. Look, these are more sophisticated questions of the same nature, which is, you have financial product X. It exists in the real world. It's used in this certain ways. It's a loan, it's a swap, it's a derivative, it's a whatever. And now you can do it on a blockchain. Okay? I mean, great. You still have the question of, why do you need to do it on the blockchain? Who wants to do it on the blockchain? what are the trade-offs versus doing it the traditional way? And there will be some answers for which it makes sense, which I think are going to be similar to the answers for paying with cryptocurrency. Oh, you want to do it in an uncensorable way? Sure. Great. For sure. Oh, you live in some country where you somehow can't get access to this? Yeah, okay. Oh, you have a machine-to-machine economy and they need access to this? Yeah, that makes sense. Do you, if I'm the type of sophisticated person who needs this type of sophisticated product and I normally get it from the bank, and would I now get it from a chain? Are the terms better than on the chain, the bank? If they're not, and I don't have one of those other three uses, I don't know why I'd do it. If they are, well, they're not yet, I don't think. And so that's an interesting question. When do they become better? How do they become better? And what does that mean in terms of the customers? So the DeFi stuff is a super interesting experiment, I think, at this point. It bears watching. I can't say yet, from my opinion, others will think differently, I'm sure, that, oh, look, here's this specific usage case, and it's going to go supplement the way we do this today because of X. Here's the reason it's better. And I gave you 3 potential reasons it could be better, but those aren't the average user. Right? That's not me. I have not yet myself come across a reason I need a decentralized financial instrument, which is not to say that I won't in the future. Some type of super advanced programmable money that can replicate financial instruments from primitives and is accessible to all. Yeah, it's one of those like theoretically, conceptually interesting ideas. But I'm a little less clear of when and how the user is attracted to that. So, might sound like a wishy-washy answer, but I think as where we are now, I think I'm right. Okay, everyone, we are at 8 minutes past, so I'm going to wrap it up here. Thank you once again for joining. I appreciate your questions. I appreciate the